The United States is currently facing a mounting debt crisis that raises serious questions about its economic future. With the government borrowing extensively to support various initiatives, concerns about long-term financial stability are escalating. Ted Oakley, managing partner and founder of Oxbow Advisors, highlights that this overwhelming focus on government debt might be hindering other vital areas of economic growth. He predicts significant economic challenges in the next 5 years if immediate and decisive actions are not taken. Despite reports of GDP growth, Oakley suggests these figures may be misleading due to inflation. Consumers are struggling with rising prices, and over half of the U.S. population faces financial hardship. Additionally, Federal Reserve interest rate cuts might offer only temporary relief, while market volatility and increasing consumer debt further complicate the economic landscape. With these pressing issues at the forefront, one must wonder, are current economic policies paving the way for a sustainable future, or are they merely masking deeper financial instabilities? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The escalating U.S. debt crisis. As the United States grapples with an escalating debt crisis, the sustainability of its economic growth and overall financial health is under intense scrutiny. The government's heavy borrowing to fund a plethora of initiatives has triggered alarm bells among economists and financial experts. Ted Oakley, the managing partner and founder of Oxbow Advisors, warns that the overwhelming focus on government debt could be detrimental to other crucial sectors of the economy. In an interview with Kitco News anchor Jeremy Zaffron, Oakley emphasized, "You do get in a situation after a while where you're using so much of the money you create in the country to buy your own bonds." He predicts significant challenges within the next 5 years unless decisive actions are taken. The illusion of GDP growth. The reported GDP growth has sparked debate, with Oakley suggesting that these figures may not accurately represent the economic reality for many Americans. He pointed out that a significant portion of the GDP growth can be attributed to inflation rather than genuine economic progress. For instance, in the first quarter of 2024, GDP growth was reported at a rate 25% higher than initially forecasted. However, much of this growth was driven by rising prices, not actual economic advancement. This discrepancy between GDP figures and actual economic conditions is evident in the daily struggles of consumers. More than half of the U.S. population is currently experiencing financial hardship, struggling to cover basic expenses amidst soaring costs. The Consumer Price Index, CPI, has surged, straining household budgets and exacerbating economic disparity. Federal Reserve rate cuts, temporary relief? The Federal Reserve's decisions on interest rates are closely monitored by both investors and economists. The current federal funds rate stands at 5.5%, and there is speculation about potential cuts as the election approaches. However, Oakley cautions that these cuts might offer only short-term relief. If the Fed funds rate is 5.5%, how many times do you think they'll cut before election time? My guess is, if they did anything, it would be one. As a trade, that doesn't make any sense to us, he remarked, suggesting that any market response to rate cuts could be fleeting. Inflation remains a significant concern, with the latest CPI data indicating persistent upward pressure on prices. This inflationary environment complicates the Fed's decisions, as it must balance the need to control inflation with the desire to stimulate economic growth. Market dynamics and the rise of consumer debt. The year 2024 has been characterized by significant market volatility, with substantial gains in the indexes driven primarily by a few key stocks, notably the Magnificent Seven: Amazon, Apple, Google, Microsoft, Meta, Tesla, and NVIDIA. NVIDIA, in particular, has shown remarkable performance, reporting a first-quarter revenue of $26.4 billion, a staggering 262% increase from the previous year. However, consumer debt and delinquencies are also on the rise, adding another layer of concern. Credit card delinquency rates have surged, and auto loan delinquencies have reached troubling levels, exacerbated by high interest rates and economic uncertainty. These trends reflect broader financial strains among consumers who are grappling with high costs and stagnant wage growth. The broader economic implications. The increasing focus on government debt, combined with misleading GDP figures and rising consumer debt, paints a troubling picture of the U.S. economy. The reliance on borrowing to fund government initiatives could crowd out investment in other critical areas, potentially stifling long-term economic growth. Furthermore, the illusion of GDP growth fueled by inflation fails to address the underlying economic challenges faced by many Americans. As the Federal Reserve navigates its interest rate policies amidst persistent inflation, the potential for only temporary relief through rate cuts raises questions about the effectiveness of current economic strategies. The market's heavy reliance on a few key stocks further underscores the vulnerability of the broader economy to significant fluctuations. The rise in consumer debt and delinquencies highlights the financial struggles faced by ordinary Americans, suggesting that the economic recovery is not as robust as GDP figures might imply. High costs and low-wage growth continue to strain household budgets, contributing to an ever-widening economic disparity. Conclusion: the U.S. economy stands at a crossroads, grappling with an escalating debt crisis, misleading GDP growth figures, and rising consumer debt. The sustainability of current economic policies is in question, as the government borrows heavily to fund various initiatives, potentially crowding out investment in other vital sectors. With inflation complicating the Federal Reserve's interest rate decisions, the long-term health of the economy remains uncertain. As we navigate these complex economic challenges, it is crucial to consider whether current policies are truly paving the way for a sustainable future or merely masking deeper financial instabilities. Are we addressing the root causes of economic disparity, or are we content with temporary solutions that may lead to greater issues down the line? Share your thoughts on how the U. Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.